So obviously we've been through a bit of a rotation here in the first quarter. It's not the first one we've been through. We've been through many of these in the past. And I think the important thing to remember is for our core holdings is that earnings growth drives stock prices in the long run. And so often it's important to remember what you're actually investing in here. You are trying to find those few winners. And when you find those few new winners, you don't want to give up on them because you're worried about inflation or et cetera. And so from that point of view, this is an interesting slide that we like to remind people of. And it's really Amazon over the last 7 years. And so on the left-hand side, we're showing you Amazon's forward EBITDA over that 7-year period, where it grew from roughly $10 billion to $70 billion over that time frame. And on the right-hand side, we're showing you Amazon's EV to EBITDA multiple over the time frame. So what multiple of its EBITDA did it trade on over that time frame? And you can see that it's traded between a range of 30 times and 15 times. So it's had lots of re-ratings and de-ratings over the journey, but ultimately it's the EBITDA that has driven the stock to 7 times its money over that time frame. So the company has effectively perfectly matched its earnings growth. And so I think the important thing to remember is while re-ratings and de-ratings will come and go, don't let it change your view on what you think is a core winner like Amazon. Or put more simply, wouldn't you be upset if you sold your Amazon 3 years ago because you're worried about something that Donald Trump said? It doesn't actually make sense. Wouldn't you be worried if you sold your Amazon because you're worried about inflation? It doesn't make sense. And so for those core holdings, we do very much try to stay true to them here because we know that there's few winners, and we do fully expect Amazon's EBITDA to continue to grow from here all the way to $150 billion. And so from that point of view, we still see a path to this company doubling over the next 3 to 5 years. Beyond some of our core holdings, it's also important to flag that the economic recovery does allow us to broaden the idea set that we can look at. And so while last year markets were very bifurcated, now we have a broad economic recovery on our hands. And so there are whole parts of our universe or area of interest that we can start looking at again. These are things like emerging consumer stocks, so things like aerospace and luxury goods, are areas that have been in the fund in the past and that we have invested in again since the recovery has started. Other areas like semiconductors that we've liked for a long time do well through lockdown, and they also do well in an economic recovery. And so the semiconductor period has been very, very good for us as well. And we do like these companies over the long term, both through a recovery and also through lockdown. And then lastly, most importantly, our climate area, which is one of our biggest areas today, is obviously hugely leveraged to stimulus spending and very much also helps through an economic recovery as companies refurbish or rebuild or spend for the future. They will obviously do this in a more green way going forward, and we have a number of holdings there we quite like. And so between those areas, we can actually broaden the portfolio and broaden this areas of earnings growth into the future.